Hi students, so welcome back to class number 27 on CMA and Financial Management. I think today we are completing the standard costing topic, and our last topic for standard costing is sales variance and profit reconciliation. So we started with material variance, labor variance, fixed overhead variance, variable overhead variance, and finally we have come to sales variance and how to do the profit reconciliation. Okay, so this is for today's class. Let's go inside today's class. So what is sales variance? So if you see, any variance is the difference between the budget and actual. Okay, now coming to the sales. So what is your sales is nothing but your revenue. What is that? Number of quantity of goods sold multiplied by what are the selling prices of the goods, and that will be your sales value, or you will call it a sales revenue. So revenue or sales is a product of your sales quantity and selling price. So you have budgeted some sales quantity, you have budgeted some selling price, and you have budgeted selling price multiplied by budgeted sales quantity is going to be the budgeted sales. Now actually you have done some sales during the period for which you have budgeted. In that period you have achieved some actual, whether that may be lesser than the budget or more than the budget. So so the actual quantity and actual price will be the actual sales. So why the budgeted sales and actual sales is different? There may be many reasons. Reason number one, selling price may be less or more or different from the budgeted sales. For doing you would have given some offer or discount, because of which your selling price has gone down, and because of which your sales may be lesser than the sales that you have budgeted. So selling price is one culprit. Change in that practically will make some cost for the variance. Same way the sales quantity. During the budget, you would have thought 1000 units will be sold, but actually you have sold 900 units or 1100 units. So it may be adverse or favorable variance. So the first culprit is the selling price, and second culprit is the sales quantity. So these both are the culprit when it comes to one product. And if your company is having some 10 products, okay, and each product you have budgeted 10 numbers each during the budget, but when actual comes, one product is sold 15 numbers, other product is sold 8 numbers only. So when multiple products comes into picture, the culprit is not only the price. The variance between the budget and actual is not only because of the price, but because of the price, because of the quantity, and also because of some mix that has happened between the products. So particular product has sold more, another product has sold less. This is the multiple product scenario. So I classified this sales variance problems into the single finished goods problem. A company is having only one product, okay, or multiple finished goods. That is more practical. Any company will have multiple products only. So multiple finished goods case. So here in the single finished goods case, standard quantity into standard price, it's going to give you the budgeted sales. That is the sales that we have budgeted. Okay, and there is the actual sales, actual quantity sold multiplied by actual price, selling price. That is the actual sales. So what is the standard sales? For the actual quantity that is sold, what will be the budgeted selling price? Okay, so that is the standard for the actual quantity, that we call it as standard sales. So this is for the single product scenario. So sales value variance is budget actual, the total end-to-end variance. And students, the most important thing that we have to watch is material variance, wages variance, or labor variance. All those variance will always do standard minus actual. But when it comes to sales, we will do actual minus standard, because this is output based variance. So we will always do actual minus standard. So here you can see sales value variance is nothing but 2 minus 1. 2 I call it as actual sales minus budgeted sales is the sales value variance. Now management is asking you what is the variance, and you are saying because of sales this is the variance. That is called sales value variance. But management will not leave you. They will ask question, how much is because of the selling price difference and how much is because of the volume difference or sales quantity difference. And that is where we have to give the breakup of the sales value variance into sales price variance and sales volume variance. So as usual, sales price variance and sales volume variance, if you total it, it will match with sales value variance. And this is the advantage of standard costing. Any problem you do, you can verify your answer whether it is correct or not. Okay, so this is called single finished good scenario. We will go to the multiple finished good scenario where the mix of the product will also cause variance along with the quantity and price that is already causing some variance. So when it comes to multiple products, the company is having a lot of products. Each product will have some actual quantity that is sold and budgeted quantity that is planned to be sold and actual selling price and standard selling price. Okay, so now we call it as standard quantity, standard price as budgeted sales, actual quantity, actual price as actual sales, actual quantity into standard price is called the standard sales, and there is a revised standard sales just to calculate the mix variance and sub volume variance. Okay, that is the revised standard sales, which is the revised standard quantity multiplied by standard price. So revised standard quantity is nothing but standard quantity divided by the total standard quantity of all the product. Okay, standard quantity of A divided by total standard quantity of all the product multiplied by total actual quantity of all the product. So what we here we are trying to do is standard. Okay, the standard quantity, if you total for all the product, that will be X, and if the actual quantity, if you total for all the product, it will be Y, and we are linearly projecting the standard quantity, what will be the scenario at the actual case, and that quantity we call it as the revised standard quantity. For problem which has multiple products, and when it is asking you to calculate the sales variance, you have to follow this approach. The same, this will not change. Sales value variance, sales price variance and sales volume variance, this is not going to change between the single finished goods and multiple finished goods product. But there is two more variance that is coming into picture, which is sub volume variance and mix variance. So sub volume variance is nothing but the revised sales, revised standard sales minus the budgeted sales. So revised standard minus budget, because budget moves to the second part. Okay, that is called output variance. Always the standard or the budget will move to the second part, and that is called the sales variance. But that is not the case during the material variance or labor variance. Okay, so if you see the mix variance is nothing but the standard sales minus the revised standard sales. So standard sales minus revised standard sales will give the effect of mix of product that has caused the variance in the sales value. Okay, so now as usual we can tally the answers. Sales sub volume variance plus sales mix variance will be equal to sales volume variance. Same way, sales volume variance plus sales price variance will be equal to sales value variance. So once you have completed the problem, you can just apply this formula and check whether your answers are correct, and then you can confidently move out of your examination hall. Now we will fastly cite the problems. Okay, so yes, so illustration number 19. So there are multiple products. A, B, C, D is the product. So standard sales quantity is given, standard selling price is given, actual sales quantity is given, and actual selling price is given. And what is the revenue of the company is nothing but the quantity multiplied the selling price as per budget. During the budget, we budgeted for 76,800. The actual is 90,000. So from here itself, you can know the answer. 90,000 minus 76,800. So what is that? Difference is 13,200 is the total variance. and this we are going to project to the management, and we are going to give the breakup of this variance. So 90,000 minus 76,800 is the 13,200, which we call it as sales value variance. So management will ask you this value variance, how this has happened, how much is because of price and how much is because of the volume, for which you have to calculate what as per the table which we discussed in the last slide. So I am just putting what is actual quantity given in the question, standard quantity given in the question, actual price is also given in the question, and standard price is also given in the question. So I am filling this table, and I am finding the budgeted sales, SQ into SP, and actual sales and standard sales. I can find it, but for revised standard sales I need to calculate the revised standard quantity, because revised standard sales is equal to revised standard quantity multiplied by standard price. Standard price we already have, but how to find the revised standard sales? Revised standard sales is nothing but standard quantity of 1600 divided by total standard quantity of all the product, which is 4000. So 1600 divided by 4000 multiplied by 5000 will give you the revised quantity. Apply the same formula for all the product. You can find the revised standard quantity of all the product. Multiply it by the standard price. You can find the revised standard sales. So we have already discussed this formula. Apply the formula and calculate all the variance. So from the question itself, 90,000 minus 76,800, 30,200 is the value variance. Now, with this formula, if you calculate the price variance and the volume variance, you have to add this, and that should tally with 13,200. So, price variance is minus 8,550, volume variance is 21,750. Add these two. 21,750 minus 8,550 will tally with 13,200, which means you are going to get the full mark for this problem. Same way, calculate the sub volume variance and mix variance. Add the sub volume variance and mix variance, that will tally with the volume variance. So if this is correct, your whole problem is correct, and you will get the 4 marks or 5 marks what is allocated to this problem. Next problem we will go. That is also very simple problem, and here the question is having one mistake here, and the question is having little twist also. Okay, there are only two products, and you have a budgeted sales quantity and actual budgeted selling price, which you used for the budgeting purposes. Now during the actual, what has happened is the selling price is 5 for some quantity of sales, but 4.75 you are in a position to give a discount, then only you can achieve the sales target. So that's why maybe 5,000, 1,500, 6,500 you have sold, but budget is only 6,000. So the selling guys or marketing guys are very clever, they have given some discount and achieved more sales than the target. Okay, so they have four prices, selling prices in the actual. Just apply the same table that I have seen. So the product of, I'm just putting A and A. Okay, actual quantity is different because of actual selling price is different. So it is 8.5 given in the question. There is a mistake here. It is actually 1.9. Okay, we have to correct the question that is given in the book. It is 1.9, and we are just applying the same formula, and we are just calculating all the factors responsible for the variance, and we are applying the same formula to calculate the variance. And here also you can just multiply the budgeted units multiplied by selling budgeted selling price, and actual units multiplied by actual selling price. You can total and calculate the budgeted sales value and actual sales value. The difference between those two will be the budgeted sales minus actual sales. Sorry, actual sales minus budgeted sales will be the 450. That is the value variance, and all other variance should total and tally with this. So I hope this problem will be easy for you. Just I took some efforts that we should not be worried when multiple selling price, multiple actual selling prices are given. It is as simple as that, and just apply the same table that I have given to you. Okay, now we are moving to the next problem. This is illustration number 21. Here the question is, from the following particulars period, reconcile the actual profit with budgeted profit. Okay, so material, wages, all the things are given. Net profit that is given here 4 and 8.5. 4 lakhs is the net profit and 8.5 is the actual net profit, and here they have missed to give that it is sales. 100 is the sales here and 126.5 is the sales here. Okay, actual sales is 126.5, budgeted sales is only 100. Actual material price wage rates were higher by 10 percentage, actual sales price were higher by 10 percentage. So students, when this question comes on your paper, most of the student doesn't know that this is standard costing question itself. So when something is asked like reconcile the profit, okay, it is a standard costing problem. What is reconciliation of profit? What is the actual profit, what is the budgeted profit, and what is the difference between these two, and that difference is called variance. So variance will come only under standard costing. So this is a standard costing problem. That is the first thing we have to be clear. The second thing, everything is given in the question. This question you should not leave itself, you have to attend this question, because answer is also there in the question itself. We will not go wrong in this question itself. Okay, so what we have to do, we have to reconcile the profit. What is the profit? 4 lakhs is only my budgeted profit, but actual profit is 8.5, and management wants, as a financial accountant or as a cost accountant, management wants you to explain to them that why this change has happened or why this variance has occurred. Now management has asked you, now you are coming and checking what is the budget P&L. So during the budget, you would have forecasted all the expenditure and made a P&L statement. Now, what is the actual P&L statement you will take from your SAP system or any other ERP system? Now you are going to group all the expenses, because the expenses will be like 1 lakh line items, and you will group the expenditure and compare what has done this change. Okay, so what is the reason for this stage? Now you are doing this activity. Now, okay, so here it is given blank, but it is sales. Okay, so 100 is only 100 lakhs is only the budgeted sales. Actual is 126.5, which means your sales is more. How much it is more? 26.5 lakhs the sales is more, which means the sales variance is a favorable variance. Okay, which means the sales value variance is very simple. Actual sales minus budgeted sales, it is 26.5. And just like that, you cannot go and say, sir, budgeted sales is this much, actual sales is this much. Because of the difference in the sales, 26.5 has come. Management needs more value addition to any analysis that we do. So what is the value addition we are going to do? How the sales value variance has happened. How much is because of the price and how much is because of the volume. Okay, that we are going to find here. Okay, so budgeted sales is 100, that is given in the question. Actual sales is 126.5, that is also given in the question, and it is said actual sales price are also higher by 10 percentage. So selling price is higher by 10 percentage. Okay, so so it is given in the question actual sales prices higher by 10 percentage, which means actual price is equal to 110 percentage of standard price. It's 110 percentage of standard price. So this 10 percentage higher price is also sitting inside this 126.5. So from this 126.5, if you take out that 10 percentage, then it becomes a standard price into actual quantity. So what is standard sales? Standard sales is actual quantity into standard price. Actual sales is actual quantity into actual price. So actual price is 10%, 110 percentage of standard price. So 100, so you can just divide it by 110 percentage and you can get actual quantity into standard price, which will be the standard sales, that is 115. So this most important thing to calculate is the standard sales. I hope you understood. Please rewind and watch the video, and now you can apply this formula. The value variance you already have 26.5. Price variance can be found to be 11.5. What is 11.5? That is what is the 10% extra that has happened as given in the question, that is sitting in your actual sales. When you remove this 10% that has happened because of price, the price variance will go out, and price variance is 11.5. The remaining variance that is sitting is 26.5 minus 11.5 is 15, is because of volume that has happened. Now you have calculated all the sales variances. Now we will go for the next variance that, okay. So here next variance is material cost variance. Easily it is given in the question itself. Budgeted is 50, actual is 66. So actual material cost is higher. Material cost. So cost wise, if it is higher, it is a unfavorable variance or adverse variance. But sales we discussed 100, 126. Actual is higher. That is good for us. Sales revenue is good for us. Sales value is good for us. But material cost higher is not good for us. So material cost higher by 50, 66, 16 lakhs. 66 minus 50, 16 lakhs material cost is higher. So the material cost variance is going to be 16 lakhs adverse. So that's why minus 16 lakhs is coming in the material cost variance. So it is very simple. Now management will ask what is the breakup. So how you will say the breakup? So you have to calculate material price variance and material usage variance. So how to calculate material price variance and usage variance? For that you need the budgeted material cost, which is standard quantity into standard price, already given in the question as 50. Next, actual quantity into actual price, which is the actual material cost 66, that is also given in the question. But how to find the actual quantity into standard price? That by applying the same logic that we applied for the sales. Actual material price and wage rates were higher by 10%. So which means actual price is 110% of standard price. AQAP, which is nothing but actual material cost, it is given as 66. Now instead of AQ, okay, so instead of AP, I am substituting 110% of standard price. So 66 divided by 110% of standard price. And standard, what is standard material cost? Formula for the standard material cost, AQ into SP. This is what we have to calculate. Now AQ is nothing but 66 divided by 110% of SP. So selling price, both standard price will get cancelled. 66 divided by 110% is 60. So standard material cost is calculated. Just see, it is very simple. So what is standard material cost? It is actual quantity into standard price. For standard price, we have for standard price we have to and it is given in the question, actual price is 110% of standard price. We are just applying the logic and substituting this in the formula. We are finding the standard material cost, that is 60, that has come here. Okay, and now we can easily find what is the price variance. Price variance is nothing but actual standard material cost minus actual material cost will be because of the price variance, change in the price. Okay, but that is called price variance. So since it is material, we have to put standard minus actual only. Okay, now what is the usage variance? That is because of the usage, which is nothing but uh, standard quantity minus actual quantity bracket multiplied by the standard price. That will give you the material usage variance. Usage is money change because of the change in the material usage quantity, how much variance has happened. This is material cost variance that we can take from the question itself. We can verify our answers. Material price variance and usage variance we can calculate. We can add the price variance and usage variance and tally with the material cost variance. That is going to be as simple as that. Okay, and exactly the same logic we have to apply for the labor cost variance also. So here also it is given, actual material and wage rates were also higher by 10%. So apply the same logic that we have done for the material cost, and you will land up at calculating the standard wages as 30. Budgeted wages is given in the question as 30. Actual wages is given as 33. Standard wages in the same way we can calculate and it comes to 30, and the same formula we can apply and can see that labor cost variance is 3. How to tally this, whether it is correct or not, that also we can see here. 30 lakhs was the budget, 33 lakhs was the actual cost is more than the budget, which means it is the adverse variance, which means the variance is -3. Adverse means negative sign, -3. So labor cost variance is -3. Okay, moving to the next topic, which is the fixed overhead variance and variable overhead variance. So variable overhead variance budget is 6, actual is 7, which means adverse variance of 1 lakh. So adverse variance of 1 lakh has happened in the variable overhead cost variance, and this is because of the expenditure. What is expenditure variance? Expenditure variance is budgeted variable overhead minus actual variable overhead. 6 minus 7 is -1. So -1 is the variable overhead variance that is tallying with this. Very simple. Next, what is the fixed overhead variance? That is given in the question. 10 is the budget, 12 is the actual, 10 minus, okay. So 10 minus 12, which is nothing but -2. -2 is nothing but adverse variance of 2 lakhs. That is the variance, and that is because of the expenditure. What is expenditure? Actual budgeted or fixed overhead minus actual fixed overhead. That is called expenditure variance. Next, we have calculated all this variance. Now we are going to do the profit reconciliation. What is profit reconciliation? What is the budgeted profit? And when you add all these variances, you will get the actual profit. What is the material cost variance, labor cost variance, fixed overhead cost variance, variable overhead cost variance, sales value variance? So only the sales variance is favorable. All other variances are adverse. Calculate all the variances and add the variances with the budgeted profit, you will land up at the actual profit. So 8.5, 8.5, it is tallying. So which means we have reconciled the profit. So it is very simple. So reconciliation of profit means it is a standard costing problem. Calculate all the possible variance for the factors that is given in the question. Here in the question, they have missed to give that it is sales. So you may confuse that this is the total. 100 is the total of all these things. No, students, this is the sales. 100 and 126 are sales. They have left this cell blank, but it has to be mentioned sales revenue, sales or revenue. Okay, but when you see your question after this video, they have mentioned little things different. What is that? They have mentioned something called material volume variance and wage volume variance. So what is this? Okay, because we have studied material price variance, material usage variance, mix variance and all. We have not studied about the volume variance. It is very simple, guys. Because of change in the volume, how, okay, if you are selling 100 units and material cost is 1 rupee, 100 units into 1 rupee will be the budget, which is 100 rupees will be the budgeted material cost. But actual material cost is also 1 rupee, but actual quantity that you have used for the production is 120. So price wise there is no change. Material cost as per budget is also 1 rupee. Material cost as per actual is also 1 rupee. But budgeted quantity is 100. Actual quantity is 120. Because of this, 20 rupees you will have variance, and that variance is because of the volume that has happened, and that we call it as material volume variance. Here I have put a small logic. Budgeted sales is given in the question as 100, and they have given in the question that 10% selling price has gone up. So if I give effect to this 10%, okay, so 110% of 100 will become 110. Next, actual sales is 126.5. Okay, 126.5 is the actual sales. Okay, so 110 is the budgeted sales adjusted for actual price. So actual price effect is brought in, but actual quantity effect is not there in this. When I take the actual quantity, actual price, it is 126.5. So 126.5 minus 110 is 16.5. That is the effect of sales variance, that is because of volume. So how much sales volume has gone up from the budget? It is 16.5 divided by 110. It is 15%. Okay. So 15% your sales volume has gone up and 10% your selling price has gone up. Because of this, you have got a very good favorable sales variance. How much is this favorable sales variance? 126.5 minus 100, which is 26.5 lakhs. You have got benefited purely because of these two variants, which is the selling price 10% increase, volume 15% increase. And here I have done a small derivation to find how much percentage because of price and how much percentage because of volume. Price is already given in the question as 10%. So how much because of volume is 15%. Now material volume. What is material volume variance? So it is also a part of usage variance. Okay, usage is nothing but the difference in the quantity. Okay, so volume is also a quantity factor. So here material volume variance is nothing but 50 lakhs is the projected or budgeted material cost. So 15% of it is nothing but 7.5 lakhs is the because of volume. Okay, you have sold higher volume, which means higher materials would have consumed for them and higher material cost would have happened or hit it in the P&L account, and that's why this variance has happened. This variance is good for the company. Actually it is an adverse variance. This has facilitated for you to do more sales. Okay, you have recovered all this variance with the selling price or sales revenue. Okay, so 7.5 is the volume variance. We have already calculated in the previous slide. Material usage variance is 10. Out of this 10 lakhs adverse variance, 7.5 is because of volume. Remaining 2.5 you can have it as usage variance. So we have already completed the problem. Now to match with the book, I am saying you, if you want, some students want to go as per the book, that is well and good. Okay, for that what is the logic? I am explaining just the logic. If you want to show only the material usage variance, well, go ahead, that we just discussed now. But if you want to share material volume variance and material usage variance as given in the book, then this is the logic for it. Okay, you can calculate the material volume variance, usage variance separately and reduce the usage variance to that extent, then only it will tally with the material cost variance. Okay, so the same logic you can apply for the wage volume variance also. Budgeted wages were 30 and volume increase is 15%. So wage volume variance is 30 lakhs multiplied by 15% will be 4.5 lakhs. Increase in the volume means increase in the wages, which means it is adverse variance, but it is good for the company. We are going to recover it because we are having a very good profit favorable variance in the sales. Okay, so this 4.5 lakhs you can reduce from usage variance, that is 0. Usage variance is 0. All the labor cost variance was because of wage rate. Okay, 10% wage rate was higher na? Everything was because of that only. So the usage variance were 0. So if the volume variance becomes 4.5 adverse, then usage variance will become 4.5 favorable. Sum total of this variance will be 0. All the variance in the wages because of wage rate only. Okay, so this is a very important problem, guys. I hope you get this problem in your examination because all the answers is there in the question itself. Only thing you have to attend it, you can verify it, you can with full confidence we can come out of your examination hall. That's why we are going for standard costing type problems. All the very best, guys. Meet you in next video with further topics. Thank you.